There's a big warning sign right now, and it tells us that interest rates could once again go up. I know this is a property channel. I'm always meant to say about how prices are going to go up, but this is a real warning sign. In this episode, let's look at what this flash sign is. Let's look at the various other ingredients that can tell us whether interest rates will go up or down and the consequential impact on property prices. Very important episode, don't miss it. I'd love for you to hit the subscribe button, give it a like, but more importantly, hopefully you get value and actually watch all the way through. Let's go. So this is the warning sign right here. It's the containerized global shipping cost. This is the spot price of shipping costs. And you remember back in 2021, it started to rise a lot, whether it's the Shanghai shipping composite or the Drewry composite. And there was a lot of conjecture by all central banks globally, of course on this channel as well, whether this was a transient supply chain shock because of COVID, because of lockdowns, people at the ports, etc. not working. Therefore, the shipping containers weren't getting put onto ships. The ships weren't delivering our goods from one country to another, especially out of China. And when COVID would subside, those ships would be back on their way, inflation would be tamed, and it was all because of supply side impacts. We now know that that inflation was not because of just supply side impacts, but rather also demand side. Otherwise, by now, it would have subsided, which it hasn't. It has come down, inflation's come down, but it's not gone away completely beyond our target range. But check it out. This is exactly what caused the inflation beast to rear its ugly head in the first place. In 2021, these shipping costs went up, and then of course they came down in 2023. Inflation started to come down, both supply side and demand side. But check it out, and I don't think anyone is talking about that. It's flying under the media radar. In 2024, this has started to go up again. And I thought, look, it could just be a blip because it came back down, but now it's started to reverse that downwards trend and is looking for another steam up, another trend up. And it may in fact rise again up to half or 75%, or who knows, all the way up to the spot price back in 2021. Of course, this is happening this time, not because of COVID, but in a large effect because of what's happening in the Middle East with Israel and Palestine tensions not really subsiding. There's a lot of issues with the shipping channels like I've gone through in previous episodes, and that's really causing tensions in global trade, and therefore shipping costs are rising. This is not a good thing for inflation. If this continues to go up, we may see the downward dip in inflation reverse, buck, and start to go up again. And that's terrible because interest rates can't do anything to impact supply side inflation in this respect. But let's zoom right back out and go through the arguments that say that the genie of inflation has not been put back into the lamp. The number one ingredient or argument is that services inflation and trimmed mean inflation, which is a measure for underlying inflation, it remains sticky, okay? Yes, goods have come down, but services due to labor costs have continued to be sticky. The second argument is that wage growth could have another run, another bull run, keeping the services inflation high as the labor market remains tight. The third argument is that the budget, the Australian federal budget, has provided additional stimulus to the economy on top of the stage 3 tax cuts. We're all getting tax cuts in July, and that's not a good thing to tame inflation. And the fourth argument is that the RBA cash rate is in fact still below comparable countries like the ECB, Canada, US, UK, and New Zealand. So a lot of the hawkish commentators are saying these are the reasons why inflation could continue to go up. And of course, the spot shipping costs that I just introduced, which no one is really talking about, which is more on the supply side. All this bodes really bad for interest rates. If this is all true, then interest rates could just be at this level for a long time, or could in fact go up once or twice again. What would that mean for house prices? We'll get into that in a second as well. But I want to go through some charts that illustrate the other side of the argument, that actually inflation is basically tamed. It's all on its way down. Yes, it's not going to be a smooth journey, but for all intents and purposes, it's coming down. We can say goodbye to further interest rate rises. Let's go through some charts that may illustrate this. The first one is Australian economic indicators. Now, there are leading indicators that tell us what may happen to the economy in the future. There are indicators that are not causal, but coincidental to the economy's strength. And then there are indicators that are lagging. The economy's already done something, but these only tell you about the economy after the fact. There are three really important indicators like building approvals, consumer and business confidence, and the yield curve that are key leading indicators. And leading indicators in the green in this chart are suggesting that we are definitely in a softening period. See this green line coming all the way down. The last time we had a recession because of COVID in 2020, this green was all the way down here. Before that, in Australia, we had a recession in early 1990s. The green was all the way down here. Before that, early to mid 80s, we had a recession and the green was all the way at sort of -2. That's really what it takes for us to go into a recession, -2 territory. If it stays at -1, for example, around the GFC time, we didn't go into a recession. So really need it to go well below what it is now for us to hit recessionary territory. So this tells me that a recession is not likely to come, but the leading indicators are definitely suggesting the economy is weak and no more interest rate rises are likely required. The second chart is NAB's price indicators, purchase costs, labor costs, and final product prices. All three measures are coming down consistently. There's not been any blips in the last few months. So if this carries on, this tells us that once again, inflation is basically done and dusted and on the way down. The Australian pipeline inflation indicator looks at energy and agricultural commodity prices, shipping rates, China PPI, Australian price surveys, SEEK advertised salaries, and it all goes to understand how the economy is faring. And if you look at the Australian CPI year on year, and then the Australian pipeline inflation pressures with a 4-month lead, we see that generally this red line, this pipeline inflation indicator, leads real CPI. And right now, the blue line, the pipeline inflation, is coming all the way down, which is a good thing. And it suggests that real CPI is probably going to come all the way down within our band of 2 to 3% inflation that the RBA wants. And if you look at Australian employment versus job leading indicators, we see that employment growth has still been buoyant, and that's why the unemployment rate isn't really ticking up as fast as the RBA wants it to. But check this out. This is the insight here. Jobs leading indicator advanced by 3 months. On the right-hand axis, this green line, it shows that despite employment rising, the number of jobs that are out there from employers to employees is really fallen off a cliff. And falling off a cliff is not a hyperbole in this sense. I mean, back in 2021, 2022, it was actually beyond the scale of this chart. And now it's all the way down to almost zero growth. Now, it's not as bad as it was in the GFC where it had experienced negative growth, but once again, it tells us that the economy is cooling, the appetite from employers to employees is shrinking. All good things to tame inflation, especially wage growth and therefore services inflation, which is the key problem within the inflation basket. Now, normally I would say, well, all this tells us that, okay, interest rates may not go up again, but it's pointing to a very weak economy. And even if interest rates don't go up, that could mean house prices start to shallow out, because let's be real, house prices are in a big way impacted by the real economy. They're not just a speculative asset from overseas investors. So how Australia performs is how the Australian real estate market performs. But in this case, I don't want to make that conclusion, and this is unprecedented because we're seeing a chronic shortage of housing. Everyone knows that. I don't want to sound like a broken record, but check this out. Dwelling starts per quarter. We're seeing the number of new houses actually getting out of the ground, actually construction starting right now, to be basically almost at the same level as 2011, 2012, when the population level was more than 3 million less than what it is now, and we were only taking in about 200,000 immigrants every year, whereas right now we're taking in well over 350 to 400,000. So in a normal environment, I would say, guys, we can't really expect the housing market on average to go up double digits, with inflation coming down, which is a good thing, but coming down because the economy is softening, both on the demand and supply side. But in this case, we're seeing the Australian economy become softer, but we're seeing almost no houses being built compared to the demand, especially fueled by overseas immigration. Therefore, even if the Australian economy is not doing that well, we're seeing house prices continue to go up. I think everyone knows this. I've done so many videos with hundreds of charts articulating this housing shortage nationally. And here's the proof. Right now we're seeing Perth really go exponential. Darwin, a little bit flat. Melbourne has been stop-starts, had a few false starts. Brisbane is starting to go exponential. Adelaide somehow keeps rising at such a fast pace. Hobart has had a huge run and now it's consolidating, but not falling dramatically, which is very surprising to me in this part of the Hobart cycle. Canberra flatlining, but once again not falling. And then lastly, Sydney making up for its lost time in 2022 and continuing to rise. Put aside this housing crisis, put aside this housing shortage, I would expect right now Darwin to be falling. I would expect right now Sydney to be falling. I would expect right now Melbourne to be falling. I would expect Hobart to be falling, Canberra to be falling, only Perth and Brisbane and Adelaide to be the ones rising, but nowhere near the double-digit growth rates that they're experiencing now because of a soft economy. But because there's no houses, that is why, and that is the only reason why, it's supply-side-led housing boom in these locations, not because of demand. So in conclusion, there is a warning sign. Inflation could be on its way back up if the supply side shipping costs, what's happening in the Middle East, continues to get worse and worse. But if that doesn't, then all roads point to inflation being tamed because of a shallower, softer Australian economy, which in ordinary times would cause the housing market to retrace. But right now, because of governmental policies over the last 2 decades, there's just not enough houses. Even if we cut immigration by half, there's not enough houses being built. Therefore, in these locations, house prices are continuing to go up. It's a weird economy, guys. Let me know what you think. Hit the subscribe button if you got value. Give it a like. My name's PK. I'm always so grateful to be able to serve you in this way. Thank you so much.